Joining us now is Sylvia Jablonski, CIO and co-founder of Defiance ETFs, and Meera Pandit, a JPMorgan Asset Management global strategist. The two-year Sylvia is back above 4%. Maybe I'm torn. I would like to say the last 2 weeks, I'd just like to say never mind in terms of a banking crisis. But then again, I think that the Fed needs to at least acknowledge that something did get broken. Maybe it wasn't their fault. The risk, obviously, managers out at SVB were asleep at the switch. If they had any risk management, they were in a different business. But when things like this start happening, Credit Suisse, and the angst last week about Deutsche Bank, I mean, it has to be on the Fed's radar. Do you think they're going to continue hiking, Sylvia?
Yeah, good morning, Joe. I think that's a great point. I think angst has to exist here. This doesn't, we don't kind of get away from this unscathed, in my opinion. I think that there's some trickle down effect on this, and it might be something like regional banks can't lend as much to small businesses, and then Main Street doesn't grow, and then that impacts GDP to some sense. So in my mind, I do think that perhaps the Fed raises another 25 bips or so, but I think at that point, perhaps he kind of pulls back and kind of looks at the environment around us to see what's happening, because I think you're going to get a lot of deflationary pressure because of what happened in banking. I think you have a lot of investors that have left the market and jumped to treasuries, and have left banks and jumped to treasuries now. And that's going to impact the overall ecosystem and the economy too. I think you spend a little bit less when you worry about, you think back to a 2008 banking crisis. So all of this, coupled with inflation actually coming down, though not in a linear fashion, I think does bode well for the Fed not continuing to hike this year.
Meera, that's a good point. Even if there aren't any other shoes to drop anywhere in the financial sector, the remaining players in that arena could pull in their horns, though, so not give as many loans as they have been, and actually be more cautious, which is disinflationary and actually might be like 50 basis points. Some people say as much as 100 basis points that the Fed doesn't need to move just because the banks start doing it on their own.
What we have to recognize is that lending standards have already been tightening for several quarters in a row. And this is before some of the banking woes that we've come across in recent weeks. So we're already in an environment where credit conditions have tightened. I wouldn't want to undermine that point there. So we're already in that environment. This banking crisis has, of course, heightened that potential slowdown in credit growth. And look, there are both economic reasons and financial stability reasons for the Fed to pause. I mean, on the economic side, 70% of the recent print of CPI came from shelter. We know that is lagging. We know that is slowing. Ultimately, it's going to take a little bit longer than the Fed would like to see progress on inflation. But it's not just the inflation. I mean, they're worried about wage growth when the reality is for the last 23 months, wage growth has been eroded by inflation. So it's not like there's this huge amount of spending power from the consumers. And inflation expectations are well anchored. If you look at both the New York Fed survey, the University of Michigan survey, we've seen that inflation expectations 1 year ahead are the lowest since spring 2021. So when you marry both the economic reasons and the financial stability reasons for the Fed to pause, it really makes a lot of sense for them to tap the brakes at this point.